Welcome to the Decision Makers. Hi, I'm Jerry Sont. Today we look at cash as an investment choice and the considerations it raises for banks and advisors and other people working in the wealth management industry. We'll tackle some of the common issues and concerns surrounding cash and provide some in-depth insights into client requirements and some solutions to meet those needs. In this program, Decision Makers will share their thoughts with you. I'm speaking now with Jim Bulling, partner, Middletons. Jim, welcome to the Decision Makers.
Thanks, Jerry.
Jim, what impact will the government's proposed tax changes regarding the accessibility of interest income have on the savings patterns of Australians?
Well, Jerry, this was going to be a big driver of savings patterns when it was first talked about by the federal government, but it's been watered down significantly since it was first discussed. Now we're only having a phase-in of some tax concessions spread over 3 years rather than being introduced in the next couple of years. There's talk about the initiative being means tested, and that would count out obviously potentially a large proportion of the savings population. And the amount of the tax concession is very modest, it's got to be said. So whilst it was being talked up as a potentially a big driver to address the savings deficit, I don't think that will be the case in practice.
The federal government plans to remove its guarantee on bank deposits in October 2011. What effect do you think this will have?
Well, this was a significant initiative when, in the depths of the GFC, the government introduced federal government guarantees for bank deposits. There was a tsunami of funds switched to bank products after that introduction and away from managed investment schemes and from other investment products. But the removal of the guarantee won't be anywhere near as significant as its introduction for a couple of reasons. Firstly, it's being phased out. The government saw how significant the funds changes were when it introduced the initiative, and it caused some dislocation in financial markets. And the government don't want a repeat of that dislocation, so they're going to phase it out gradually. And secondly, consumers are a lot more cautious about their investment decisions post the GFC. And I think once the government guarantee is withdrawn, people will be a lot more conservative about the way they move their money, and that money will stick with banks for some considerable period, I would think.
Self-managed super funds are a rapidly growing sector in financial markets. What are the likely needs for cash products amongst self-managed super funds, and what are the sorts of queries asked by trustees?
Well, the sort of queries that, if I could just answer that question, taking the second question first. Yes. The process involved in setting up a self-managed super fund is pretty straightforward. You execute some documents, you notify the tax office, you set up a bank account, and you transfer money from existing superannuation funds into the self-managed super fund. So, as you can see, cash is an important part of that whole process. And self-managed super funds have been very significant providers of funds to banks on cash deposit. There's something like $110 billion invested by self-managed super funds in cash. So self-managed super funds have a big demand for cash products, and in the next 12 months the figures indicate that something like 25,000 new self-managed super funds will be created in that time, and each of them will have something of the order of $1 million to invest, and much of that money will find its way initially into cash, and much of it will stay there. So there'll be a big demand from self-managed super funds for cash products in the next 12 months and going forward.
What is the impact of borrowing by self-managed super funds having on the demand for cash?
Well, some commentators have said that as self-managed super funds take up borrowing opportunities, which they've only been able to do in the last couple of years, that this will reduce the amount that self-managed super funds have available for cash. I'm not sure whether that will necessarily be the case, because Where self-managed super funds go and organise a loan to invest in property or shares, which are the two things that they most commonly do, they still need cash to meet the principal and interest repayments that they organise with the bank, and they need cash because many of them are in pension phase. So there's still a big need for liquidity within self-managed super funds, with or without a gearing facility.
How can advisors demonstrate the value proposition to their clients in relation to commission earned on deposit products from July 2012 and onwards?
As we know, from July 2012, advisors will need to get the agreement of each of their clients before trail commissions can be paid. Now, this is the old threat and opportunity issue here. The threat is it's going to be more difficult for advisors to justify the payment of commission on a basic deposit product. I mean, they will be able to advance a value proposition for more sophisticated investment products. You know, they're monitoring performance, they're monitoring asset allocation, they're monitoring risk for those sophisticated products. A bit harder to do with cash because risk just isn't there. They're all exactly the same. And it's going to be difficult for an advisor to say, look, you know, I'm working hard at monitoring the performance of this deposit facility when performance varies, you know, in such a small way. The opportunity is that in order for advisors to be able to sell the value proposition of this commission payment, they'll need to work the commission discussion into some other discussion about a new piece of advice. So if the dialogue with their client leads to more sophisticated discussion about investment strategies or innovative product placement or for instance, self-managed super fund gearing strategies, that'll be a good thing both for the advisor and the customer.
Jim, as a decision maker, thank you for your insights today.
It's a pleasure, Jerry.